Good evening. Welcome to Learn with Stanley webinar number 47. And today is actually going to be the part two of our webinar that we have did 2 weeks ago, which is decoding a financial statement into a story. Welcome everyone tonight. And I'm so grateful that you guys have chosen the time to share this hour with me. And I hope you guys are doing well. Let me know where you are logging in from. And today, let's get started. Okay. And of course, as usual, is a simple disclaimer. Do note that currently I work for IFAS Global Market, but this presentation is created and researched by myself and doesn't uh, hold any relationship to my employer, and all the opinion raised here are my own and does not represent any investment advice. So welcome to Learn with Stanley webinar. This is something that I do every 2 weeks. I've been doing it for more than a year now. And within it, I try to talk about analysis of funds or ETF or stocks that I've been looking at, and also giving you guys educational investing content as well. So I'll not touch too much on this today as we have a very, very full presentation. But this is something that I'm doing for my clients at IFAS. And if there's something that you want to speak with me one-on-one, you can definitely go to my website, learnwithstanley.com, and there will be a button for you to reach out to me either through social media or through my email or through this QR code. So last 2 weeks ago, we went through part one of this webinar where we talk about understanding the income statement, balance sheet, and also cash flow statement of uh, of a uh, of a company, and understanding how to interpret this number into a story that we can uh, have a clearer idea of what the company is really about. And to me, reading an annual report is like reading a storybook. We are reading about the 1 year adventure of the company. It could be a company that you are totally new to. It can be a company that you have been following for decades and decades, and just what is the next episode that is happening for that company. And when I see it like this, both whatever that the statement or the wordings that they have presented in the front compared to the financial numbers at the end of the annual report, both must match up together. So in a way, when I read through the numbers, I'm trying to formulate a story that I can deduce and decode from all these numbers, and I'll compare it with what the management is telling me at the front. In a way, it's also a cross check for me to understand truly, is the management being truthful to me, or are they withholding any information from me that I can detect from looking at the numbers. So today we're gonna go through the cash flow statement with you guys with our last 2 weeks example. But then later on, we're going to have a few real life example of other companies, the entire financial statement of these companies. We're going to go through it together and formulate the story of these two companies, and then maybe coming up with a decision of understanding what a great company will look like or what a not so great company looks like, and what is the difference, what are we really looking out for when you are analyzing a company by yourself. So I really got very excited, and I would say that my first experience and touch point of learning about financial statements and understanding how to read an account really come from this book and also this documentary, Enron, the smartest guys in the room. And at the time, this was the biggest financial engineering fraud of its time. If you guys are not familiar with Enron, it happened a long time ago. Enron basically is an energy trading company, and at one point they are almost one of the largest company in the New York Stock Exchange. And how they are able to grow so fast is that it turns out that the company is buying or creating new projects, utility projects that they take over. And most of these projects will have a long earn out period, maybe 10, 20, 30 years of holding the uh, the trading contract for these power plants. But instead of booking their revenue uh, as it happens, they found a way to book the entire revenue of that project upfront. Say if they have a project and a plant that is going to give them a contract for 30 years, instead of booking the revenue year by year, they book the entire 30 years revenue at one go. And that really boosted their revenue, as you can expect. And then they keep on going through this fraudulent M&A activity to boost up their earnings every single year. And a key part, which I'm going to touch on later, on how it all unraveled, it is found within the financial statement. There's one part of the financial statement that leads to discovering this fraud. And the company, once one analyst discovered this, something is going on, and a fraud is happening within the company. Within a few months, the company completely collapsed, and the company went into bankruptcy. And the fall of this company actually led to the fall of, at the time, the big five accounting firm, Arthur Anderson, as well. So now we have the big four accounting firm, but previously Arthur Anderson was among some of the biggest ones, and it led to the complete resolution and of this auditing firm. So very fascinating, and learning about this history and this story at a time when I was still studying, it piqued my interest about investing. It also piqued my interest about finance, understanding financial statement and how financial engineering really come about. So this is the key. The key of bringing down Enron comes inside the cash flow statement. If you guys have heard of Enron or have read this book or gone through this documentary, do put up on your chat and then share with me maybe your experience or when you heard about it, and what do you think of it, or there are other companies that similar or you have come across. Do share with us on the chat box as well. So the cash flow statement, typically I read it at the end. So after understanding the income statement and the balance sheet, I'll look into the cash flow statement. But the cash flow statement is something that I look at to help me link the entire financial statements together. This is the part that in my opinion, is the part that is least probable to manipulate and to make big assumptions that change the figures. Whereas in the balance sheet and in income statement, it actually has a pretty big leeway for management on how they want to book their revenue, how they want to book their costs, what appears inside the balance sheet. There is still some leeway for management until today on creating this financial statement, but less so for the cash flow statement. And that's because, very frankly, the cash flow statement is a statement to tell us the exact physical cash movement within the company for that year. So everything at the end has to tie up with the exact cash amount that they have from the beginning to the end. And that is why it is much more harder to change this number or to window dress these figures overall compared to the other two financial statement. So in the cash flow statement, it's break down into three main parts. The first part is what we call cash flow from operation, which is what we have here. And you can think of it as these are the cash coming into the company or going out from the company from the business itself. So this is if you have a restaurant, the money that you earn from your customers, the money that you're paying out to your suppliers, to your salary, to your employees, and to your rent, to paying your rent. This will be all under cash flow from operation. How much did the operation bring in for that year in terms of cash? The next part is the cash flow from financing, for investing. This is coming from additional investment that the company will do every year. When I talk about investment, it's not about buying stocks or buying stocks or making buying Bitcoin or things like that. But it it mostly for an operating company comes down to buying physical machineries, properties, uh, your vehicles or computers that will be parked under cash flow from investing, what you are putting into the business to maybe make it grow or expand the capacity for the future. This will become in cash flow from investing. And then the last part is cash flow from financing. And as the name suggests, this will be the cash flow coming in or out for your dealings with your financier, be it your equity holders, your investors, or be it your debt holders, your bond holders, or the banks, anything like this. So, where you're getting the money to finance the business will be parked under cash flow from financing. So, first one, cash flow from operation, and we'll go through it um, briefly. I wanted to highlight to you how typically this number comes about. This is the first part of cash flow of from operation statement, and it always starts with the net profit of the company. So this is basically trying to show us how the net profit of the company in the income statement evolve into the actual cash coming in and out of the business. So from our last week example, which is Sembcorp Industry, their profit ended the year with about 1 billion Sing dollar. And this will be the starting point for this, the cash flow from operation. From this point, what are some of the key adjustments? Normally, you will see the biggest sum of adjustment comes from things like depreciation and amortization, because inside the income statement, they will need to book in the depreciation of their asset, their properties, their cars, their computers, their machineries. Everything will be parked and inside depreciation. But this is just a accounting number. In real terms, because they have already bought all this capex in that year, there's not really something that need to pay out, right? There's no bill or invoices that they need to pay out as depreciation. So typically this number will be positive and it will be add back to the profit, because they're actually the profit would be actually higher in terms of cash if they have some depreciation. Make sense? Some company, they would adjust out the financing income and costs. So the financing costs with the interest that you're paying will be taken out. This one actually depends on different jurisdiction, but sometimes in some area, they are allowed to put financing costs within cash flow from operation, because paying all this interest costs is paying all this interest costs is part of doing business as well. So, but in this case, the cash flow cost is being taken out as well. So, although they pay the interest about 300 plus million, these are taken out as they are deemed cash flow from financing rather than cash flow from operation. So these are some of the key things. But for this company in particular, if we remember, there is a big chunk of profit coming from the associate and the joint venture. So in this case, the joint venture, are companies that they have invested in, has made a lot of profit, but sometimes this profit might not flow to the parent company, it might not flow to Sembcorp Industry because the profit is still kept within the joint ventures and the associate. So if there's no cash coming from this investment, then they will have to be taken out. So although on the income statement, this part make around 300 million, those are not real cash coming into the company, so they will be taken out as well. So these are some of the key things. Of course, there will be smaller things that typically happens within it. You can see, I think I will not go through all of them as they are not super important in this case. For example, you might add in tax expenses. For now, for here, you'll take it out, but actually you will add it back later on as well. And maybe things like, let me see, things like share-based compensation, equity share-based compensation. So if you are paying your employees stocks options or share grant, there's no real cash outlay from the company, so they might add that back as well. So then when you do up everything, you have a different number. And from there, this is the income statement that I just want to showcase to you guys the starting profit number. But we reach a point where it says operating profit before working capital change. So the operating cash flow actually before working capital change. So these are numbers that the cash received by the company before they change any of their working capital. And then from there, they have to work in the change in working capital. What is working capital? Working capital is basically the money uh, that is needed to make sure the business continue to run. So as you're running a business, sometimes you need to buy more inventory. Sometimes you are owning your supplier. Sometimes you are waiting for cash coming in from your suppliers. You're paying out your suppliers. Uh, Things that have the cash that will be floating in and out or through in a very, very fast manner within a few weeks, within a few months. So all this it will change year on year, right? Your inventory level will change year on year. Your receivables and your payables will change year on year. When you adjust for it, the final number is you can see 1.6 billion. So although this company make on the paper they make 1 billion in profit, in paper profit, when we adjust it and look at the actual cash coming into the company for that year, is actually 1.6 billion. And then, of course, at the end, the tax that you actually paid, still 200 million. And then, so the net cash from operating, I beg your pardon. I beg your pardon. The net cash from operating activities end up to be $1.4 billion, which is pretty healthy, right? The actual cash coming into the business is more than what they specify in their income statement. That's a good sign. Many companies might not show such a thing. Many companies might end up having a very high profit here, right? They may show a very high profit, but when you look at the cash flow statement, sometimes the cash flow statement might be negative instead. How does this happen? And this is the main key indicators in Enron case that blew the bubble, which is they found out that for many, many years, the operating cash flow was always negative for a long period of time, even when the company has stopped growing. So why is that the case? A few things that the company can do uh, to have such a situation. One of the most easiest way is that the company can actually, number one, pay more and more of its employee in terms of shares, right? If a lot of their employees are being compensated with equity, they don't really need to pay out a lot of cash for them while the people still work for them. Uh, or or a more common approach that management might do is increasing the receivables, meaning that they are extending the credit term for the customers. For example, if today, if you are, let's go back to the restaurants business, right? Typically, most restaurant business, they run on a cash basis. After you eat, you pay. Say, for example, one of the restaurant in need of boosting their revenue, then they come out and have an offer saying that patrons coming to eat in our restaurant, you don't have to pay today. Come back next month and pay up. Or you can create a tab, right? You can just spend whatever you want, and then at the end of the month, you pay us. So when that happens, maybe more and more people would want to eat in the restaurant, right? Because you don't have to pay any money upfront. So more and more people would spend. But at the end of the day, if they can or cannot collect back the money, is in doubt. So many companies would do that, especially for companies that is doing B2B business. Most B2B business run on credit terms. So if you have a standard credit term of about 30 days that you are giving your customers, after 30 days, then you pay me. But if you just change that policy and change it to, okay, instead of paying me 30 days later, now you can pay me 90 days later. Most of the time, the suppliers, the customers would buy more from you because now they have free up their cash flow. They don't need to pay you so early. They can increase the volume of business that they want to do, and they will take more from you. But that also increases the risk of whether you can collect from them, right? And a lot of time, this risk and this issue doesn't surface straight away. It might take years before the customers fall into financial difficulty. So during that few years, while you change this policy, your revenue and profit can boost up extremely fast. But when you look at the cash flow of that few years, then you might see a different story. It might be negative even, and that would prompt you to understand that something is happening, uh, and maybe the company is not growing based on true fundamentals. There's one big yellow flag that you can look out for. So we talk about how the cash flow statement might differ from the income statement, and we talk about some of the key things that is most instrumental in changing that figure: depreciation, your interest costs, things from associate, and of course your working capital. So those are some of the key things that I want you to highlight. I want to highlight to you when you're looking through a cash flow statement. So if you have any question along the way, feel free to pull up the chat box. If you're using a computer, right, on the control panel, you should see a chat button. And when you click on it, you will be able to chat with me. Or if you're connecting through a smart device, then it should be at the bottom when you click on the three dots, and you will be able to see the option to open up the chat box as well. Give it a try, and because later on I would need more participation from you guys, and I'll need more comments and analysis directly from you guys, right? So try it out now. So let's go on to the next statement, which is from cash flow from investing activity. So this cash flow from investing activity, um, a few things I wanted to highlight to you guys here is this will be considered cash that have gone in and out based on both. If you're investing into, say, if a company decide to invest in equity market or the bonds or buying, money market funds or just putting into fixed D, those are considered investing. And all the way to acquiring a new company, buying another property, buying more machineries, buying vehicles, even buying softwares and acquiring softwares, and things like that will be all under net cash of from investing activity. And how you read it, the cash flow statement is a little bit different from the income statement and balance sheet. In a way, in the sense that negative and positive number just indicate the flow, the direction of flow of the money. And it doesn't necessarily means that negative is bad, positive is good, right? It's not really the case. It just means that negative means money going out of the company, and positive means money coming into the company. Why do I say that that doesn't indicate good or bad, right? Because that in cash flow in investing, sometimes having some negative number is actually good because it means that the company is reinvesting in the business, is using its cash that it has to try and buy more properties, buy more equipment to upgrade itself, to increase its capacity so that it can sustain and create more business in the future, right? Whereas if you see a company where for many, many years, if its cash flow from investing is always positive, it means that the company is always taking money, is always trying to encash its investment and not really reinvesting back in the company. And for such a company, maybe in the long run, they will lose their competitive edge. They might, basically be liquidating the company away, and the earning power of the company will slowly come down more and more if that trend continues. So this is something for you guys to understand, that the positive and negative number just means the flow of the cash. So in this case, in this company case, a big part of it is still coming from actual acquisition and investment into the business rather than true investing in the sense that buying things, the financial assets, right? So number one, we can see that positive coming from dividend received. So this would be coming from things like is joint ventures and is associate the investment. They have pour back some money back to the company as dividend. Interest received, the interest that they earn from their either buying a bonds, putting money into money market funds and things like that for cash management. This will be some money that they have taken up, and also proceed from their divestment, disposal, their sales of property, and all this will be within here. But what is more appropriate and important for us to look at is actually on the bottom side, which is acquisition. Either they have made new acquisition in terms of investment in their joint ventures or buying out more companies. Number one and two here. Not so much the financial asset, right? Buying financial asset is not that important. might be just part of cash management, putting money into the fixed deposit, putting money into money market fund for a while to manage the cash flow. Next is purchase of property, plant and equipment, the PP&E. This will be important as well because if they are buying more property, plants and equipment, hopefully that will build up the capacity and the economic mode of the company, and also purchasing of tangible asset. This could be part of buying a company where it comes with tangible asset, intangible asset, or purchase of software or IP outside of the company. So all this you can see that the company has disposed of something and that money is coming in, but they also use the money to buy more PP&E, buy more investment into their joint ventures and associate, and also their other subsidiary as well. So all in all, they have spent $1.4 billion. So just now, the cash flow from operation, they made 1.4 billion, and they have used up the entire 1.4 billion in the investing sector as well. So that's basically what the company is telling us. But from these two parts of the cash flow statement alone, we can come up with a number, and a very, very important number called free cash flow. And free cash flow is indicated by Warren Buffett as the most crucial and critical matrix for us to monitor. And this is a very, very important matrix for in the future if you want to value this company. And he terms it as the owner's earnings. So meaning that instead of just pure looking at the income statement and the net profit that the company is making, a more reliable way to see how well the company is doing over time is looking at these free cash flow numbers. And these free cash flow numbers is basically having the formula of cash flow from operation. So just now we have deduced that the cash flow from operation is about 1.4 billion for this company, minus what we call the capex, which is the capital expenditure. And the capital expenditure is basically the money that the company is using to either make new M&A, buying more companies, doing investment into other joint venture and associate, or buying property, plants and equipment, things that would help increase the business over time, right? So bear in mind, it's not minus off the entire cash flow from investing, but rather just the part where we consider capex. And for this example, we can say that capex would include things like acquisition of subsidiary, investment in joint venture associate, buying properties, buying intangible asset, and then maybe you can want to offset it with disposal of all this as well. And then the net figure would be considered a capex. So just on using my estimation right here, this figure could be roughly about 2 billion. So the free cash flow for this company could be something like 1.4 billion minus it actually spent about 2 billion of capex. So the free cash flow is negative 600. So they have spent more on capex than cash flow coming in from the operation. Having a negative number again might not necessarily means a bad thing. Instead, this number is something that we should be monitoring over a longer period of time. So if we can look back at the last 5 years or the last 10 years and look at how this number changes, right? Sometimes it's up, sometimes it's down. But if overall we can see that it is still a positive number and overall we can still see an increasing trend, then that is a sign of a company that is doing pretty well. The free cash flow back to investors is increasing. And that is the sign that we want to look into. maybe before we talk about cash flow from financing, another thing to highlight for free cash flow is that maybe a question for you guys. What kind of company do you think would have very, very good free cash flow? And what kind of company typically do you feel that would be almost impossible to have positive and good free cash flow? Free cash flow. I hope you guys can put up the chat box and then let me know some of your answers on that. While you're doing that, we can go into cash flow from financing. This one is pretty straightforward. And I think this is important, especially for companies that has a lot of debt. We would see that how the cash flow is moving in and out of the company and its relationship with its borrowers and also its shareholders as well. So in this, some of the key things that you should take note of is when a company raise more equity, be it if they have a private placement or they have a rights issue where they raise money or when they have an IPO, the proceed that the money that coming in into the company would be parked under cash flow from financing because they are getting the money from investors and it is a financing activity. So it will come under things like this, a proceed from share issue uh, or proceed from IPO, you will see. On the other hand, when the company buy back its shares, and this happened a lot in US companies, where this is the preferred method of repaying back to their shareholders instead of giving a dividend, where most of them will get heavily taxed, the company will instead purchase back the shares in the open market. And when the money is going out of the company, this will be parked under cash flow from financing as well. In this line called purchasing of treasury shares, meaning the company is buying back its own shares. And you can see that this is a negative number. Other things could be more directly is the proceed from borrowings and repayment. So this will be new loans that is approved and released to them. And these are the loans that they have paid back. So you can see for Sembcorp industry, because it is a rather heavily debt company and it's being financed typically from debt financing, you can see that this is a pretty big number most of the time that they have taken out additional 5.3 billion of loans, but they have also in the meantime that year pay back about 4.3 billion. So it's an ongoing loan refinancing for the company. Next is things like dividend. If a company pay out dividend to its shareholder, it's actually put in financing activity. You can see dividend backs to the shareholders of the company. And these will be some of the most important part. And of course, sometimes they park interest paid under here as well. Interest paid to the banks here. Sometimes some company will put this as part of operation, right? There is some leeway in different jurisdiction on where you want to place this. So these are some of the key things that you want to understand. So just looking at cash flow from financing for this company alone for this year, you can see that the company has issued some shares a little bit, not much. The company has buy back its shares, also not much. The company has refinance and pay back much of its debt and then proceed with new debt. The company has given some dividend back to shareholders and also make a big interest payment to its bank as well. So these are some of the things. At the end of the day, this is a slightly positive number. And this is the part where I think of all the cash flow statement, this is the part where the positive and negative number here at the end doesn't necessarily mean too much. So for cash flow from operation, the desired outcome for us is that we want to see a positive number of cash flow from operation. Then the cash flow from investing, typically we want to see a slightly negative number so that we know that the company is reinvesting. But in this case, for financing, I would say that regardless of whether it's positive or negative, it's not that important. The important part is just to understand where the money is flowing in and out between the company and its investors and its debtor. So this will be more important in reading the details here rather than the last number. So let's go back to the previous question that I have for you guys, which is what are the companies that you think would typically have good free cash flow? Some of the companies that typically would have very, very bad free cash flow, right? As Ivan has pointed out, negative free cash flow, a lot of time airlines is true. It's true. And it's not to say that they always have negative free cash flow, but a lot of times they do, especially a growing airline would typically has very negative free cash flow as the asset that they need to buy is so expensive. Right? Every airplane that they buy is so expensive, hundreds of $1 million, that it puts a drain on their cash flow. Next, Zhe Yong, yes, you also mentioned airline as well. That companies with very high capex like airline would typically has weak free cash flow, but the company with lesser actual capex, such as a software company, tends to have better free cash flow over time. Yeah, that's good. And I saw a comment missing, but it's okay. We'll go back to it. So that's basically the three key cash flow from the company. And at the end, these cash flow from these three segments, operation, investing, and financing, has to add up and tie back the cash that the company has before the year and the cash that the company is holding at the end of the year. And which is why I said that this statement is pretty hard to manipulate, because at the end of the day, it needs to match your bank balance. And bank balance is something that is very hard to manipulate, right? You just go to the bank. What is your bank balance at today? What is the bank balance at the end of the year? And through these three statements, you need to match it up. And you get this number, right? The beginning of the year, they'll have a figure, 730 million. And at the end of the year, the figure is 850 million. How do they match up these two figures? And there you have it. And you appear something like this. So you can see, you'll be able to see that it will match up with the cash equivalent. For this case, you can see that there is a slight difference of 850 compared to 871. But when I read through the notes here, it basically, there are some restricted cash that the company is not allowed to touch. It could be just their OD facility, their overdraft facility, or funds that they have put in as to secure some debt. Either way, these are not money, although it's there, but they are not allowed to touch it at all. So it will be taken out from this calculation. Okay. Any questions so far? Like any part that might be confusing to you? Do let me know before we start with the example that we can all go through together. So, a summary of what we have found out just by reading the three financial statement of this company without reading any writing about the company. I didn't even tell you before that. I never even tell you the name of the company. Just by reading these three statements, we are able to understand quite a lot about this company. And bear in mind, I have not once talked about any financial ratios or matrix that you have to memorize formulas. There's nothing that I have talked about where uh, we have to, put it into Excel and then do some magic in Excel to understand this company. This is just purely by us reading through these three statements. And we found out that this company is a Singapore company. It has a pretty capital intensive business, most likely have an international business, but business is not really doing so well and is mostly funded by debt with a pretty high debt number. And the cash flow year on year, just by looking at these 2 years, has not been consistent. So this company most likely doesn't have, for example, a manufacturing business where things tends to stay the same, and or businesses that tends to be subscription in nature, right? Or a service and software or solution provider that is more consistent, but rather it seems that the cash flow is quite inconsistent, meaning that this company most likely is in the project type of business. And fair enough, when I review to you guys, it's Sembcorp industry, more or less, it confirm what we already know by just reading through the financial statement. And this is the part I think which is important because we always feel that in order for us to understand the financial numbers, we need to learn all these formulas. We need to understand the relationship uh, and do a lot of Excel magic to understand the company. What I wanted to highlight to you guys is that's not the case at all. As long as we take some time to understand the reason behind each number, we can formulate what is actually happening within the company. And if you spend additional time to read through, say, the management report, the chairman's statement, or reading news report about this company, then you can tie it up, meaning what all these printed media and printed words are saying about the company, does it match what you're reading in the numbers? And you'll be surprised for many, 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 many companies, most of the time, it doesn't tie up. For example, when I was first starting out investing, I was a pretty, I would say that I spent a lot of time in analyzing companies and reading through annual reports, but I also actively seek out the management of the company through their investor relationship, right? Even when I'm a nobody, uh, I will reach out to them. I would say, can I have a meeting for you guys if they're in Singapore or Malaysia? Sometimes I drive to their office and we'll meet up with either the IRR, sometimes some companies, which maybe most of the time the smaller companies, some of the CFO will come out and meet you and have a meeting with you, right? And I did that for many years. And what I found out is when I speak to the management or the IR team, most of the time, they're going to paint you a pretty nice picture of the company, right? Most of the time, they would talk about the opportunity, the huge prospect of the business, and you will leave the company feeling that wow, this company is pretty good, pretty good. But if you spend some time to read through the financials, you'll realize that sometimes it doesn't match up. And what they're telling me doesn't match up with what I'm reading in the stock report. And I realized that most of the time, don't ask a barber if you need a haircut, right? You always need a haircut, even if you don't have any hair. And that's, kind of what I realized for doing it for many, many years. And nowadays, I try to trust the number more compared to what I hear from management or from reading memo from management as well. Okay, so as a summary from this company, Sembcorp Industry, we have already come out with a few observation, but just today, I would say that in today's age, it is almost not necessary for you to do any financial calculation yourself. Many of the data provider out there, including your brokers, like including if you have an iFast account, within the iFast software, you'll be able to see some of the key financial key metrics that is already calculated out for you, and some of the key things that you might want to look at that I will say that is pretty important is looking at growth, both in terms of say the revenue, maybe the net income, or the EPS. EPS is earnings per share. So the earnings for each share of the company, which is I think more important than the net income. And the key things that I wanted to highlight that we should focus on is the longer term average growth. So this year, the company might not do well. Some year it might do extremely well, right? You see year on year or 50+%. Some year is negative. It's not important, but I think the longer period is more important. So you can see that over a longer period, the company has been shrinking. Earnings has been growing slightly, which is positive, but overall business has been shrinking. So these are key things for us to look at. Also, some efficiency matrix. We don't have to know everything, but some of the key things that is more important for investor would be things like return on equity. So this would be how much of profit actually come back to the shareholders. And when you see this number, maybe I would say maybe more than 10% is considered pretty good lah. It's considered pretty good. Then cash conversion cycle, I think, is another thing that you might want to look at. These are basically a figure that shows you the amount of money that say $100 that the company start off with, how this $100 flow through the company and come back with profit. How long does it take? So, for example, again, if you run a business, you have to buy the inventory, pay your salary, pay your supplier, and then you wait for money to come back to you. So all this, your cash is being tied up in all these different situation, and one cycle, right? If you're preparing a dish, and the money you spend on preparing that dish, how long does it take for that money to come back to you with profit? This is in terms of number of days. So you can see that over the past few years, it takes roughly about 30 days, 50 days, 60 days, and then suddenly become negative 15 days. It's just the flow of the money. So on average, you have an understanding of this business. How long is the money tied up in the business? So I say 1 to 2 months, right? Typically, which is pretty good. Next is financial health. This would be important for us to understand if the company will fall into financial hardship, will run out of money. In the longer term, we look at things like financial leverage, how much debt to equity. So financial leverage is basically all the asset divided by the equity. So asset is equal to liabilities plus equity. It's a formula that has to balance, and it's the basis for doing the accounting. So asset is all the things that the company has is equal to all the money that it owe to debtors or suppliers or its employee plus the money that belongs to the shareholder, which is the owner. So these two has to match up. And you can see that if it has a financial leverage of 3, meaning that for every one part of, for every dollar that the shareholder owns, that the shareholder has, the company is actually having $3 something, $3.36 of asset, meaning that there is an additional $2.36 somewhere, which is being held by the debtor. So it's the money they have borrowed for them to be able to afford that asset. Similarly, it can be some if we think on a personal level, your home mortgage or your car outstanding. So if your car is worth 100,000, if you put a 20% money down at the start of it, your financial leverage for that car would be 5 because 100,000 divided by 20,000, it's 5. So for every dollar that you have, actually another $4 is owed to the bank. So that's how you read it. So this number, if it's the higher, it means that it is not in a good place. And for me, I tend to be more conservative. And this number, I would say that I want it below 2 most of the time. And another important one, maybe you want to look at is interest coverage. So this one is the I will not go into details on what the formula is, but it basically the meaning of this is uh, how much how much from the profit of the company can they pay out to pay the financial interest of the company. So if the company is paying out 100 million of interest payment to the banks every year, if it's making if it's making if it's making 400 million, so it has a interest coverage of about 4. So the the profit that it has can pay the interest 4 times over. So if this figure becomes closer and closer to 1, it will highlight a problem because the company might only have enough profit just to pay back its interest. So these are some of the key important metrics I think that you can consider to look into. Um, and all these figures are quite easily available. Okay, so are you ready to put everything into practice? We'll go through it quickly as time is running out. But I'll just put through a few examples, and then you guys tell me what you found from this figure. I will not tell you the company. Let's have 1 minute. Right, you guys read through. This is the balance sheet of the company. Tell me one observation that you find from here. Maybe I should have the have some song up again. But let me know if you have any comment on it. I hope you guys can try it out, right? Don't have to be so worried about whether you get it right or wrong. I would say that in investing, there's no such thing as right or wrong. Uh, it's all opinion anyway, right? Regardless of if you're Warren Buffett, it's all opinion at the end of the day. Okay, this is the income statement of the company. You can see from year to year, they have 3 years of it. Is there anything that jumps out to you guys? I would say that for this company, when we look at it, you can also see something interesting, which is the revenue is not growing very, very fast, especially in the period of high inflation. It's not growing very, very fast. But the earnings are, if you look at here, earnings from continuous operation has actually been declining. So again, this is a company that might not be in a high growth sector. And from its asset and liabilities and equities, you can see that it is also a company that uh, is being financed more by liabilities compared to equities. Okay, and this is a cash flow statement. You can see that from the earnings, how it derived to the operation figures as well and the investing figures. So a quick glance is you can see that the operating is all positive, which is good. So it's something that is more consistent, that is able to bring in cash year on year. And the investing, even if we don't go through it line by line, just look at the investing figure, we can see that they have stayed below the operating figures, meaning that this company at least is producing free cash flow constantly, which is good. So I hope you guys get that. Uh, it's a shame you guys don't want to share with me. I hope you guys would, don't be so shy and share more about your opinion with me through the chat box. I just want to highlight to you guys. So with the with this company, so when we look at the key metrics that we went through just now, you can see that the growth is pretty similar. It's not doing that well, rather stagnant or negative growth. The return on equity slightly better than the previous company, and it has uh, it has uh, in years, some years their return on equity can be close to a 50%. And this company has slightly better financial leverage because it's lower and the interest coverage is 30 plus 20 plus times, meaning that the profit has enough to cover the interest cost 20 to 30 times over, which is much better than previously. So, how do we differentiate a good and a bad company, right? What is good, what is bad? I'll show you the gold standard. So, this is a financial, I would say, of one of the best company in the world. And this is what it look like. This will be considered a gold standard. You can see the profit growing every single year. The profit going increasing every single year. The revenue increasing every single year. The margin at least stays the same or improving. Both the EPS also growing. The asset is mostly financed by equity. You can see the equity is even more than the liabilities, meaning that the shareholder owns most of the business compared to the debtor. And one thing to highlight is the total cash that the company has, say 100 billion here, the total cash that the company has. When we look at the total debt that the company has, here about 3 billion, long-term debt about 40 billion. So the debt is about 43, 44 billion in debt, but the company has 100 billion in cash, meaning that today, if the company want to pay back all its debt, they still have excess cash, which is why it shows that the company is so strong. Right? They actually don't need the support of any bank to do business. And then next, the cash flow statement, which is important, where you see the cash flow from operation is always positive and growing as well. Cash flow investing, up and down, but at least they are continue to expand more and more. And the free cash flow is positive because this number is always smaller than the operation number. So the company is producing and increasing its free cash flow year on year. And this is what I mean by it's very, very hard to find this kind of company. And this would be one of the gold standard, like the best of the best company that you can find in the market. When you look at the matrix, it shows as well their growth, double digit every single year. Profit is actually growing faster than revenue, meaning that the margin is improving. Return on equity is strong, more than 30 plus percent a year. Cash conversion cycle is actually negative, meaning that they actually don't need any cash to do business, right? They need to put zero money down to actually do the business. Means that they are getting money from the customer faster than they need to pay back their employees and their suppliers, which is a sign that the company has a negative cash conversion cycle. They actually don't need any cash to do business. And of course, the financial coverage, the financial leverage, you can see that less than two, meaning that the equity is more than the debt. If you have any question at all, um, or I'm speaking too fast or too confusing, do let me know. But this is how you can tell that this company is uh, much, much better than the other two that we look at. And my question to you is, can you tell which company is this? I'll review to you guys later at the end, but you can put your guesses down on the chat to let me know that what company do you think is this amazing financial statement belongs to, right? And this is basically what I do when I'm investing and when I'm looking through either companies or even funds. I'll look through, like when I'm looking at a new ETF, an ETF that I'm looking at, I tend to look into the top few holdings of the ETF. What are the companies? I'll look through the financial of the companies to make sure that, because at the end of the day, when I invest in an ETF, I'm investing in the company underlying as well. So I need to be comfortable with all these companies inside the ETF as well. And my approach and my philosophy has always been focusing on the long term macro trends instead of chasing after the latest fact of the year. I'll think ahead, say in the next 10, 20 years. What are some of the things that I feel would continue to grow? Where are some of the markets that I feel has the opportunity to continue to grow for a long period of time? Be it that, of course, I at the end of the day, I end up focusing a lot more on tech and also consumer companies. But that's just what I'm more comfortable with. But there are so many other factors and markets out there that has long runway. And when we spot it, focus on all these market. And I focus a lot on risk management, meaning that if I have a choice of something that give me the most return versus something that I can be more certain will give me some return versus something that will give me a huge return, but something I'm not very sure of, I rather go with the one of a higher certainty. And that's how I view investing and building my portfolio, that I prefer higher certainty compared to just seeking out the highest possible opportunity out there. And then an important part is keeping calm and be okay of being contrarian. So for example, with the AI craze, I don't rush into every single AI company or known AI company that I heard about. It's okay that I miss, much of the boat. I'm comfortable with it as long as I know uh, what is important in my portfolio. And even if I go against the crowd, be comfortable with it and that understand that the market goes up and the market comes down sometimes. And if we focus on building up a quality portfolio, something that I call everlasting portfolio, it will stand the test of time and time become an ally for me in the market rather than something that I'd be afraid of. So this has been a philosophy that I followed for many years, and it has worked for my own portfolio and something that I have been trying to translate and help out with my client as well at iFast through mostly through ETF of understanding first their situation, both their investment situation and also their own personal financial situation, and then building up a portfolio that suits their personal needs, from matching the exposure that we want to give them, and then choosing, just for illustration purposes, choosing what are some of the key ETF that might suit them. And you can see that, sometimes I propose things, can be Bitcoin, can be gold, can be different healthcare sector or different markets. It doesn't matter. It's important that I propose something that suits the client needs as well. And I eat my own medicine while I create a ETF portfolio as well on my site, where I update my clients. How is it doing? What am I buying myself? And I share the risks, right, with my clients as well. So things that I am looking for them are things that I would buy personally as well. And I advocate important part to let them understand is that when we're investing, the output can only be as good as the input, right? We talk a lot about finding the right company to invest, finding the right stocks to invest, when to invest, the timing to invest. But at the end of the day, the most important part is actually the savings part. The most important part is actually putting in the money to invest. So, for example, if you can just be consistent of saving up every single month of $2,000 every single month, or $1,000, or $500, or $200 every single month, continuously for 20 years, right? Just for this example of 2,000 per month, without doing anything, just keeping it in an account, it will grow to $500,000 in 20 years. But if we can add on investment to that at maybe a 6%, and maybe a 10%, that could grow to 900,000, 1 million, 1.5 million. But the key thing is we have to do that regular action of saving and investing first. If we don't do it, nothing will come out of it. And that's basically a key thing that I want to highlight too. Like, the consistency is important. And then finding an instrument that will give us relatively good returns over time would balloon to millions and millions of dollars for each of us, right? This is the example of running a simulation for my client on financial planning, right? I understand their current situation first, their financial goals, be it buying a property, having a kid, starting a family, saving for kids' education, whatever the objective could be. Then we work backwards. How much do they need? And how much should they be investing into now, into what instrument, and what kind of risk they can take to reach that financial goal. So it's a very systematic way that I do it. If it's something that interests you, and you might want to you want to have a chat one-on-one with me, definitely reach out to me. My contact you can find at learnwithstanley.com, or just fill in this from this QR code. You can let me know a preferred time that you want me to reach out to you, or you can reach out to me on my social media as well. But do make sure that you find the correct social media that I have, and you can find that in learnwithstanley.com, my actual social media account, right? So this is my website. If you want to reach out, you can actually click on this and to give me your details, and I'll reach out to you. Or if you're in Johor Bahru, you can drop by our office as well, iFast Global Market. If you want to meet face to face, that's even better. If you want to reach out to me on social media, you can find me most active on Facebook, YouTube, and also LinkedIn as well. So thank you so much for your time. Before I review the company just now, as I always put, I have just one last slide for you guys, which is my spin-off section, just things that I have been finding out that I find interesting. One YouTuber today. Unfortunately, this is in Chinese, so I apologize if you don't understand Chinese, but this is one of the better ones that I found called Google 101, yeah, right, the Valley 101, and Chen Qian give very, very detailed analysis on what's happening within Silicon Valley. And she interviewed insiders, understanding the development that's happening within Silicon Valley. For outsider investor like ourselves, where we are not there, we're so far away from the states. I think it gives us a deep insight into what the people inside the valley and the insider inside the Silicon Valley are thinking about for the future of on what's important to them. That will be very, very useful for us. So before I go, a quote from Edward Hopper, one of my favorite artists. If you, he said that if you could say it in words, it would be no reason to paint. And as I grow older and older, I realize that arts is becoming more and more important part for me. You can see the famous painting of Edward Hopper behind Nighthawk, one of my favorite painting. And I encourage you guys to, you know, take a little bit of time to appreciate the arts as well, and not be too stressed over the day to day. Thank you so much. And the company just now, where I said is the gold standard, is actually Microsoft. And Zayong, you got it right. Congratulations. Congratulations. Unfortunately, no price. But yes, in my view, that is one of the gold standard of the company that you want to look for. It's very, very hard to find. But Microsoft is indeed one such company. So, with that, thank you so much for your time. I know I ran a little bit over time today, but I hope you have enjoyed it. I hope it's beneficial for you. Till we meet again, my name is Stanley. Invest safely, guys. Thank you very much. Good night.